Hi folks, my name is Rick Barron and I've been in the retail mortgage business for the better part of the last 30 years. I feel like I've had a front row seat through this whole mortgage mess, and what few solutions we have tried haven't helped much or even made any sense. So I'm here today to offer up something we can do that does make some sense. In a nutshell, it's a way we can recreate what used to work well in the mortgage industry while preventing what went wrong from happening again. We all agree that the mortgage securitization business is a critical component of our financial system and is essential to the liquidity of our national mortgage market. The simple way to look at mortgage securitization is that it functions as a conduit that connects long-term borrowers with long-term investors. All of the parties in between, the banks and lenders, are just short-term players or middlemen. The securitization process involves buying up thousands and even millions of mortgage loans that meet established criteria from banks and other lenders, then packaging them up into large pools called mortgage-backed securities and selling them to big investors around the world like pension funds, endowment funds, insurance companies, wealthy investors, and even sovereign wealth funds. This process keeps the flow of mortgage money available and affordable. Today, over 90% of all mortgages are securitized through Fannie Mae, Freddie Mac, and Ginnie Mae. But Fannie and Freddie are now insolvent and on life support, and Uncle Sam says they're going away. The current plan is to gradually increase their fees until it's profitable enough for Wall Street to get back into the business so Washington can get out of it altogether. I believe there's a third option and a much better way. But to understand the solution, it helps to first know how things were supposed to work and what went wrong. The traditional mortgage business worked just fine for the previous 60 years or so because we assess the risk of default by determining a borrower's ability and willingness to repay a home loan. We determine their ability to repay the loan by documenting and analyzing their income, assets, and debt profile, and their willingness to repay by analyzing their credit rating and credit history. When we verified that these four components fit reasonably within guidelines, the historical default rate was and still is less than 1%. These underwriting guidelines were established by Fannie, Freddie, FHA, and VA, and we call loans that meet these criteria A-paper or prime loans. These loans are traditional loans and have always performed well. Then from my perspective, three things happened. First, in the mid-90s, political pressure and profit pressure forced Fannie and Freddie to take on more risk by requiring them to lower their credit standards and start buying subprime loans. This gave birth to the large-scale subprime industry. These loans were non-traditional because they disregarded bad credit or willingness to repay, but they were also much more profitable than prime loans. The key point here is that Fannie and Freddie began disregarding default risk because of pressure from politicians and profiteers. Second, around 2001, we gave software underwriting programs final decision-making authority on prime loans. This was a monumental sea change because it removed human accountability from the risk assessment process. The software also allowed for less or no documentation of income, assets, or debt ratios if it perceived the borrower's financial profile was strong enough. This gave birth to the Alt-A category of non-traditional loans. Shortly thereafter, subprime underwriting software followed their lead. And third, it became possible to make mortgage loans over the internet. This enabled anyone with a computer and an internet connection to get into the mortgage lending industry. Home lending exploded as we handed out loans like free ice cream. And by 2007, we had added over $7 trillion in new, software-approved, non-traditional, mostly unregulated mortgage debt that would have never been made under traditional standard. In less than a decade, the total U.S. mortgage debt had nearly tripled from just over $4 trillion to nearly $12 trillion. The traditional mortgage business did not fail, but the non-traditional mortgage business did fail, and it almost brought down the entire global financial system in the process. Since the collapse, we have endured wave after wave of new punitive regulations and reforms. The loans made today are all traditional, but they are also the most technically compliant home loans ever made in the history of the world. That's the primary reason why credit is so tight today. A little over a year ago, in an effort to keep my sanity and hopefully save my career, I began doing research to see if the state of Texas was big and healthy enough to support its own Fannie Mae type company. Turns out it is. So then I began thinking about how to structure such a company so that it would be insulated from the risk of political and profit pressures that brought down Fannie and Freddie. Then I stumbled across the fact that in the early 90s, the Texas legislature had sponsored the creation of a small nonprofit corporation called the Texas State Affordable Housing Corporation. Its mission was to serve the low and very, very low income community with their home lending needs, and then it hit me. A state-sponsored nonprofit corporation was the answer. A 501c3 nonprofit corporation is not a charity. It functions exactly like any for-profit company. It can make all the profits it wants, but nonprofit corporations call their profits surplus revenues. There are two primary differences between a nonprofit and a for-profit company. A nonprofit does not have to pay corporate taxes as long as it fulfills its mission, nor does it pay out its profits to investors and shareholders. It gets to keep all of its surplus revenues. In a mortgage securitization company, these surplus revenues could be used to build a reserve fund to guarantee investors they will always get paid, and the fund would grow larger every year. And because it would not have to pay out profits to shareholders, the pressure to take undue risk for the sake of higher profits would be eliminated. To insulate it from political risk, legislation would be required to prevent lawmakers from ever requiring it to lower its standards or buy loans that don't meet its standards, as well as prevent them from ever accessing its reserve fund. A standalone, state-sponsored nonprofit mortgage securitization firm that buys and sells traditional loans will be insulated from politicians and profiteers and be built with assets instead of debt and leverage. It would be 100% transparent and much easier to regulate than a private company. It could go a long way towards eliminating taxpayer risk because it would guarantee investor returns with cash reserves instead of an implied guarantee from the state. It could diversify the industry away from Washington and Wall Street and be a viable alternative to the government-controlled mortgage industry. It can be funded by anyone and everyone, including governments, and contributions are tax deductible. It would support property values and boost property tax revenues. It would create a secondary market for community banks and credit unions to sell their loans to and help avoid the kind of systemic risk our savings and loans experienced in the 70s and 80s. Excess revenues above reserves could be used for down payment assistance, interest rate subsidies, and homebuyer education programs. It could allow investors access to see the dollar amount in its guarantee reserve fund to reassure them they will always be paid back 100% and offset the geographic concentration of risk. It could become the Fort Knox of mortgage banking and potentially offer the safest AAA-rated securities in the country, if not the world. And if the prototype works in Texas, it could be duplicated in other regions across the country. Having a half a dozen to a dozen regional nonprofit Fannie Mae's across the country that could tailor their programs to meet their respective regions' needs can make a tremendous positive impact in their market. The state of Texas does over $35 billion a year in mortgage loans. With just a 1/3 market share and a 1% profit margin, it could generate and bank over $100 million a year in reserves. Texas has one of the healthiest economies in the country, as well as world-class licensing and regulatory infrastructures. We have a better shot at doing this successfully than just about anybody else. So far this year, I've met or spoken with officials from TAR, TDSML, TDHCA, and TSHAC, and they all agree the concept has merit and deserves serious consideration. I also met with the economists from Texas A&M Real Estate Center, and they pointed me in the right direction to determine its functionality in the secondary market. Since then, I've spoken with capital markets professionals and whole loan purchasers, and they tell me there would be investor interest in Texas mortgage-backed securities as I've described. They also pointed out some obstacles, but more importantly, no one has been able to give me a single valid reason this concept would not work. At Governor Perry's last inaugural speech, he said, "In Texas, if something's never been done before, it's probably because we hadn't tried it." I agree, Governor, and I think I've got one for you. Folks, I believe this is a common sense way out of the woods for the housing industry, but because it doesn't pass the what's in it for me test, it needs to be created politically by the state. At the very least, it can serve as a plan B in case something happens to Fannie and Freddie. If you agree with me and you can support the concept, please forward this message to your state lawmakers and anyone you know in the mortgage, housing, real estate, and related industries so we can get this conversation started. I've written more in depth about this on my blog at goodcapitalism.wordpress.com, and you can find it by searching for Rick Barron's blog. Thanks for watching.